We're 1 minute after. I think it's okay for us to dig in a little bit. We have a good showing of people, and I'm sure some more will kind of trickle in. Also, I'll try and monitor the Q&A as much as possible. And so if you have questions, I would encourage you to post them in there, and I'll check them from time to time so I can try and answer your questions on the fly as we're getting through some of these things. Okay. So with that said, let's dig in and take a look at the first quarter of the year. Like everything with finance, we're going to start with some disclosures. So I don't want to just say yada, yada, yada here, but we're going to cover some tax stuff here today. And so we're not providing any legal, tax, or other professional advice specifically. Although if you do want to talk about your situation, I would really encourage you to email your advisor or give our office a call. Also, kind of in here is we can't predict the future. Historical returns are no guarantee of future results and all of that stuff. And so with that out of the way, let's dig in with what we're going to talk about today. As I mentioned earlier, we're going to talk about a review of the first quarter of 2021 and how things went to begin the year. We're also going to talk about the President's American Rescue Plan, or the stimulus package that was just passed and then signed into law here recently. And then we're going to talk about some of the proposed tax changes and how they might affect planning as we get into the future. Okay. And so if there's something in here other than this that you'd like to cover or that you feel like you'd like to dig deeper, again, I'd encourage you to email our office. So let's start with a review of the first quarter and talk about current market trends and where they could take us in the next few months. I've mentioned over and over, whether it's in webinars or whether it's in calls with clients or in our, we have newsletters that go out monthly and quarterly in our podcast. We have been in a COVID-induced recession, and what is going to get us out of this recession is a public health solution like the vaccine that we're starting to see roll out. And so controlling COVID is going to be critical to getting the economy into recovery stages. And as you've probably seen in the news, and you can see here through this slide, vaccination numbers are currently moving materially higher in the U.S. And the president's has pushed states to open eligibility to all adults 16 and older as of about 2 days ago. And so with this trajectory that we're on, the country is on track for herd immunity by sometime this summer. Although we are hitting a bit of an inflection point here where we have enough vaccines and certainly the logistics to get them out to everybody who wants one, but we're starting to get to the point where there's some people maybe that don't want a vaccine. And so either they're going to need to be educated on the efficacy and the safety of it, or something is going to have to go on, because that's kind of the hindrance for us moving forward deeper into summer and actually moving past this. So as we get into what went on in the first quarter, I think it was an interesting quarter for markets. As I've mentioned to many people, the indices really seemed to take 2 steps forward and 1 step back as the months progressed. Going forward, the interest rates jumped in the first quarter of the year, even though they remain at historically low levels. The 10-year Treasury yield is around 1.6% today. It finished the quarter at about 1.7%, but it began the year at less than 1%. And so that move from 0.9 to 1.7 was a pretty big jump. Although if you think about it, getting 1.7% interest on your Treasury for a decade is not so great. So we also saw some of some trends of investors being drawn to speculative corners of the market in the first quarter, including something called meme stocks. If you've heard of that, that's things like GameStop and AMC. That had to do with that big short squeeze that went on at the end of January. We also saw investments in something called NFTs, or non-fungible tokens, which is kind of a blockchain artwork, if you will. And we also saw cryptocurrency, things like Bitcoin, really come back into favor. So a lot of speculative investing going on to begin this year. And investors also shifted money out of some technology names. Really, technology names was where people ran and hid, as in Apple we trust almost in 2020. And we've seen that rotation out from technology in the first quarter and into some long beaten down sectors like financials and energy. And so as interest rates move higher, that could be good for financials. And as we all kind of get back to work, get back to school, get back to travel, get back to growing, energy is a sector that stands to benefit from that as well. And we saw that rotation go on in the first quarter. So here's a quick look at how the indices performed last quarter. S&P 5, we'll get back to this a little bit, but the S&P was up 5.77%. The Dow was up nearly 8%. NASDAQ, 2.78%. Small caps were up the most of the bunch. And then some of the international indices, which is the emerging markets, and the EFI, which is developed markets, up not quite as much. I think interestingly, though, you can see the year-to-date returns were solid, but the one-year returns are really good. So in these charts here, you can kind of see the uneven performance where we went up in January and then down at the end of January. That was that GameStop nonsense. And then we went up in February and then down at the beginning of March because of worries about interest rates. But overall, if you go back for a year, the end of the first quarter of 2020 was really when COVID was taking hold. And so you can see these annual returns are something else, where the S&P for the one-year rolling return from the end of the first quarter of last year to the end of the first quarter of this year, up more than 60%, NASDAQ up almost 80%, and the Dow Jones up nearly 60%. Very impressive rebounds from where we were a year ago. Something that's interesting, though, is in the first quarter of 2021, the Dow was up about 8%, while the NASDAQ was only up, NASDAQ was up 3%. That's a 12% annualized pace, so pretty good, but not compared to the Dow. Dow is industrials and kind of those names that will probably rebound in a very healthy way as we get out of this COVID-induced recession. But what's interesting here is that this is the biggest margin that the Dow outperformed the NASDAQ in a single quarter since 2006. So I think the real takeaway here is that tech stocks are no longer the names that are outperforming everything else in the market. We also got some news on Netflix with their subscribers slowing. Subscriber growth is slowing. And so we're kind of starting to see that across the board. I think if you're out and around and out at restaurants, you're not home watching Netflix quite as much, perhaps. And then I think really where we saw some impressive numbers also was in earnings. And I mentioned as we began this, that we were going to kind of be numbers heavy just for a bit. And as of March, 97% of the S&P 500 companies had reported Q4 earnings. And according to FactSet, the blended earnings growth rate was 3.9%. I think the important thing here is that nearly 80% of firms beat earnings expectations, which is actually the fourth highest beat rate since 2008. So really, really beating expectations. And the projected earnings growth in Q1 is about 21%. And so we're going to get first quarter earnings here very shortly. Earnings season has actually already begun. And so we're starting to get some of that trickle in. I mentioned Netflix reporting yesterday. In fact, I think with global markets rallying on the hopes that economic stimulus is going to really spur the economy, we've seen Goldman Sachs, for example, project the S&P 500 will end 2021 at 4,300 points. And that's a pretty realistic estimate given where we are now. It's about a 14% gain through the end of the year. And with the S&P up about 10% year to date, 14% doesn't really seem out of the realm of possibility. And then they further speculated that S&P is going to grow by about 7% in 2021, where the S&P 500 would reach 4,600. Now, it's tough to peer that far out in the future, December of 2022, and know exactly what growth is going on. But you make some estimates and try and read the tea leaves to see what may be coming. So some good signs ahead for earnings growth for companies. More than 40% of the companies beat consensus earnings by more than 5%, which is a pretty solid beat, and fewer than 15% actually missed by that amount. And so this is the lowest fraction of misses in the last decade. So you're either meeting or really nicely exceeding earnings expectations, and more than 60% of companies reported sales within 2% of expectations. And so really these projections that we've had have been fairly accurate. It's worth noting that you've probably heard some discussion here about a corporate tax increase and that it might affect earnings. We'll discuss this a little bit later, but it appears that something like a 25% corporate tax rate or slightly higher than that would actually cut earnings estimates by about 3%. But we think that's already kind of priced into markets at this point. And so, again, we'll talk about that in just a little bit. I'm going to take a look. I don't see any questions. I'll just remind you, if you do have questions as we go through this, feel free to put them in the Q&A box. One thing that's kind of important as we look forward is Treasury yields and yield curves, and we'll talk about that in a second. But as of yesterday, the benchmark 10-year Treasury notes were hovering around 1.6%, down from about 1.7 at the end of the quarter. And just for comparison, the 10-year Treasury was paying 0.93% when the year began. And so quite a big move, almost double from the beginning of the quarter to the end of the quarter. So a big jump in yields, and that led to some of the volatility in markets. But still, 1.6 or 1.7% for a 10-year note is historically very, very low. We're even seeing the 30-year Treasury bonds falling as the yields up to about 2.25% on those for a 30-year Treasury. So again, rates moving higher, but from a historical perspective, you pull the lens back a little further, and it's really not too much cause for concern. And I don't think equity investors are too concerned either, because bond spreads, something called bond spreads, so the difference between yields on a short-term bond and a long-term bond, are usually a pretty good predictor if there's stress in equity markets. And it's a good kind of sign of how risky investors, or how investors view market risk. And as of March 31st, the corporate bond spread is actually lower than the usual 4% and is much lower than the 21% of the financial crisis. So I don't think there's a whole lot of worry among fixed income investors or bond investors about the risk profile of the market right now. It would seem that risk is maybe appropriately priced at this point. So it's kind of more evidence of not having a real reason to worry. One other item as we look back on the first quarter is the Federal Reserve. They say don't fight the Fed. And I think another bright spot as we look ahead is that it appears that the Federal Reserve is going to continue to be supportive of the economy and of markets. And even just recently, the Fed Chair Jay Powell said that when the time comes to raise interest rates, we will certainly do that. And that time, by the way, is no time soon. So reassuring investors that the Federal Reserve isn't inclined to jump in. We don't think they're likely to raise rates until unemployment dips below 4% and inflation rises above 2%, which probably won't be until 2023 or 2024 at the earliest. I think there's a possibility that they could slow down their monthly bond purchase program. So pull back a little bit of the stimulus that's been working for the last year, but still not raising rates. They've even suggested that they haven't even suggested, they've said explicitly they're changing their inflation measure. They want an average 2% inflation over time. And so there's some indication here that the Fed may let inflation run a little hot over 2% instead of treating 2% as a ceiling for what they'll allow for inflation. The Fed chair in February said they're not going to tighten until low-income workers recover. We're starting to see that a little bit. And so there's just all of the Fed chair statements, even here in March, where they're still waiting to see the kind of inflation they want before they raise interest rates. So that's another good sign that the Federal Reserve is supportive of what's going on with the economy. I'll take a quick look here. I don't see any questions, so we'll move on to the American Rescue Plan and the infrastructure plan a bit before we move into the tax implications of paying for said plans. So let's cover first the American Rescue Plan, or the $1.9 trillion stimulus, as many people know it. And on this was signed into law on March 11th, and the president aimed to help around 158 million households get back on their feet after the coronavirus pandemic took hold. And so this is kind of a list of what the plan contains. It's a $1,400 stimulus checks that went out to most Americans through the electronic payment started on March 13th. And so it's found its way to people, and then it takes time to find its way into the economy, although we are seeing retail sales and things move higher in line with those stimulus checks. The plan also extends the existing $300 weekly supplemental unemployment benefit through early September, preventing the benefits from expiring on March 31st, as they were set to do. The child tax credit was expanded to $3,600 per child, and most Americans will receive $3,600 for each child under 6 and $3,000 for each child ages 6 up to age 17. So a pretty wide and expansive tax credit. The plan also temporarily increases federal COBRA health insurance programs value from 85% to 100%. Tax breaks were granted for coronavirus-related student loan debt forgiveness, and the earned income tax credit was also expanded. So for 2021, more workers without qualifying children will be able to claim this credit. It includes both younger and older Americans. So the childless earned income tax credit amounts will be higher as well. So no one's getting missed with this stimulus package. And then finally, it also provides a $28 billion new grant program for restaurants and bars to meet payroll and other expenses, up to $5 million per individual business. So this is a huge package. And in fact, in this next slide here, if I can get it to advance, you can see this is a breakdown that Goldman Sachs did of the American Rescue Plan, or this $1.9 trillion stimulus. And really some key points here. You can see the stimulus payments and child tax credits amount to about $520 billion. Unemployment insurance is $246 billion. Health insurance, $103 billion. Public health, $125 billion. And then education grants of $170 billion. All of this adds up. You can see here on the bottom, all this adds up to a total of 8.4% of GDP. This is the kind of, we have never in our lifetimes seen this kind of stimulus. And I can say that definitively because this adds up to well more even than what the New Deal put together, and that's adjusted for inflation. So coming off of that, we'll call it the stimulus package, the president has also unveiled his $2 trillion infrastructure plan, and this was in late March. I'm going to pause here. I see a question. Won't these stimulus packages cause significant inflation? Hasn't there already been significant inflation already this year? I'll say I don't know that we can call inflation that we're getting right now significant. We are getting inflation, and it's the first time we've had inflation since, we haven't had meaningful inflation for more than a decade now, certainly not since the Great Recession. And so, yes, I would say the worry here is that these stimulus packages will cause significant inflation. Moreover, that they're coming in a time when we're coming out of this recession. And so I think there is some bold action being taken here because the kind of stimulus packages that were passed after the Great Recession didn't cause inflation. There was a lot of hand-wringing and worry that it would, and it didn't. And so this is, I don't want to say an experiment, but there is a theory here that there probably won't be a whole lot of inflation specifically from the stimulus packages. I think when we have stimulus packages in combination with a pretty robust economic recovery, that's one of the things that can spur inflation. And then, and inflation in and of itself isn't necessarily a problem. It's okay to have some inflation because that's the fire that comes off of that's the smoke that comes off of a burning economic fire. I think the worry then is that interest rates have to go up to combat that inflation, and higher rates combating inflation can kind of pour cold water on stocks. And so that's some of the worry there. Okay, so with that out of the way, let's dig into the infrastructure plan. Congress is likely to take up the infrastructure plan as the existing 5-year plan expires this summer, and current spending really undershoots the needs for this country for infrastructure spending. And even though infrastructure has had bipartisan support, we're still seeing the usual kind of disagreements that go on and where to invest and how to pay for things. President Trump also had Infrastructure Week, if you recall. So there is certainly interest in infrastructure spending of some type on both sides of the aisle. Really, I think here, as we look at the infrastructure plan, a large infrastructure program is really going to benefit commodity prices and sector-specific equities like industrials and materials. So you can expect an additional focus also on green infrastructure through investments in tax incentives. The current proposed plan puts $621 billion into transportation infrastructure like bridges, roads, ports, airports, electric vehicle development. And the proposal also calls for allocating $115 billion to modernize 20,000 miles of highways, roads, main streets, and improve road safeties, and even $85 billion to modernize existing transit and help agencies expand their systems. There's another $80 billion to address Amtrak's repair backlog and to try and modernize the Northeast corridor that moves between Washington, D.C. and Boston. And then more for airports, waterways, ports, ferries, and then another $300 billion towards manufacturing. $50 billion of the money would be invested in semiconductor manufacturing and another $30 billion for medical manufacturing. These are areas where we've kind of shipped out the manufacturing overseas. And so it's intended to create regional innovation hubs that can support manufacturing on some of these kind of leading edge technologies. So the infrastructure plan would also allocate $213 billion towards building, renovating, and retrofitting more than 2 million homes, and another $180 billion would go towards advancing U.S. leadership in critical technologies. I mentioned semiconductor manufacturing, but also trying to become a leader in climate science, innovation, research, and development. Another $111 billion towards rebuilding the nation's water infrastructure, and $100 billion towards school-related issues, things like building and upgrading public schools, improving community colleges, increasing the supply of childcare in the areas that need it most. If COVID kind of exposed the underbelly of anything, it's how much working families rely on childcare and how it impacts not just the families, but also the workforce. So a lot of investment there. The proposal also puts $400 billion towards home care services and that workforce, $100 billion towards building a digital infrastructure to give every American access to affordable, reliable, high-speed broadband. It's almost treating internet service as a utility. And then another $100 billion towards workforce development. And it includes helping students get career tracks, retraining workers in high-demand sectors like clean energy, caregiving, and things like that. And then another $18 billion towards veterans hospitals and federal buildings. So all that sounds great, but will it pass? I think one of the big questions about the infrastructure spending program is whether it can pass, and if so, in what form will it pass? The administration's unified government, the Democrats having control of both houses of Congress and of the White House, will allow it to take on, the administration can take on a bit more of a progressive agenda, but it's still going to be moderated by really, really narrow margins. And so you have both, I think, we'll call them progressive Republicans and conservative Democrats, really, especially in the Senate, maintaining a lot of control over the direction that policy is going to take. And so Democratic leaders are going to really need unanimous support from Democrats in both chambers to pass any policy like that. And it can kind of constrain what Democrats are going to be able to accomplish, either through reconciliation or just through legislation with the required votes. I think something to note here after we talk about all the spending, and there was some, I think this is where the question was maybe getting to as well, is that we want to note that the debt to gross or GDP, the debt to GDP ratio is going to rise right now to the highest level in history. The debt to GDP or gross domestic product ratio has long been a benchmark for fiscal sustainability. And we've even seen some scholars. There's a book called This Time It's Different. And there are a couple of scholars argued that once debt reaches more than about 90% of GDP, the risks of a large negative impact on long-term growth become significant. And that's some of the worry here, right? Is debt to GDP ratio is totally blown out. It limits growth. On the flip side, you have a little bit of inflation or a lot of inflation. Inflation plus stagnant growth is stagflation. We've done that before. It's not pleasant. And so, granted, these are emergency things that are being done. Hopefully they continue to be treated as emergency and not as a sustainable, viable way of running our budget in the country. So prior to the stimulus package being passed in March, the prior stimulus package was paid for by government debt. The infrastructure plan is going to need to be paid for by raising taxes. And so now we're going to get into the tax side of things here. And I'll just take a break. I don't see any questions, but if we go along and you do have tax questions here, we can try and address them a little bit. We're going to look at the tax questions with more of a personal tax lien and also how it affects companies, and then talk about capital gains also. I think we are at historic low taxes, and it's not going to last. I think really rising taxes are going to bring into focus the importance of income tax planning and working with your advisor, working with your accountant, having those two people working together to make sure that we're making some good decisions for you from a tax perspective. We've never seen the U.S. government commit to an outlay of this magnitude aside from the two world wars. Oh, I'm going to pause here. There's a question. Is there an expectation that some of the policies will have a direct impact on certain market sectors? Will providing affordable internet be to more Americans improve tech stock values as more people are brought fully on the digital? Yeah, I think these policies can have a direct impact. I think whether it's infrastructure spending and you see industrials and materials benefit from that, affordable internet, improving tech stock values, perhaps, although the ubiquity of cell phones have probably contributed already to a lot of the value that you're seeing on the tech side, although you can't discount the kind of innovation that's still going on. So I think more broadly, not just speaking to tech, but more broadly, yes, I don't think the government can spend this kind of money and have it target certain sectors without seeing some sort of probably increase in certain values of companies that stand to benefit from this. Green energy would be another example of that. Okay, so we're, as I mentioned, we haven't seen an outlay from the U.S. government like this since the two world wars. Put this kind of in context, the federal government, the federal budget deficit coming out of this is expected to be a little bit more than 16%, according to consensus estimates. And as a percentage of tax revenue, it works out to be over 80% of annual tax receipts based on 2019 revenues. These are huge. I can't overstate how big these numbers are. And as I mentioned, the combined rescued stimulus packages of last year combined formed a larger stimulus package than the New Deal. And that's not just in dollar terms, that's actually adjusted for inflation. And then on top of that, we have added the stimulus bill that just passed, and then the infrastructure program that we talked about. So this is putting federal stimulus around $9 trillion total, with an estimated $1.5 trillion deficit in 2022. So this might be good for the economy to spur growth, but as they say, there's no free lunch, right? So today we have among the lowest tax rates that U.S. citizens ever experienced since the inception of the tax code. And as I mentioned before, it's not going to last. You look at these numbers, and one can envision a scenario where the government both increases tax rates across the spectrum as it tries to broaden the taxpayer base, and probably it will find its way also into corporate taxes as well. The top marginal tax bracket of 39% that we have 37% that we have right now, when combined with the 3.8 Medicare surcharge tax, puts the highest earners just north of 40% tax rate for each additional dollar of investment income, which is actually still below the long-term historical average. Overall, high earners pay an average of almost 22 cents of every dollar of taxable income to federal income taxes. But these top rates apply to single filers earning, for single filers, it's $523,000 a year. And married couples, if you're earning over $628,300 a year, this applies to you. So we are not all at the top tax rate. When in talking with clients, I find a lot of people presume they're at the top tax rate, and you're still paying a lot of taxes when you start adding in your state taxes, but you may not be at the tax rate. And that's probably where some of these tax proposals are going to begin. So here's a quick breakdown of the tax proposals. We'll start with corporate taxes. The corporate tax rate could increase, we don't think, to any more than 28%. And they're going to incrementally increase the taxation of international corporate income for U.S. companies. And we think this would take effect in 2022. It's still going to be well below the corporate tax rate, where the corporate tax rate was prior to the tax cuts that came in 2017. And for individual taxes, we think that Congress could reverse some of the 2017 Tax Cuts and Job Act changes, but we don't really expect to see a really net increase in personal taxes. I'll remind you that the 2017 tax cuts made corporate tax cuts permanent, but it was a temporary tax cut for individuals. And so that was going to sunset over about 5 years. And so the top marginal rate might go up a little bit from maybe back to 39.5% from 37%. And we might see some more limitations on itemized deductions. But that's really kind of all we expect. I think I mentioned on here, Goldman Sachs also expects that the capital gains rate may go up to about 28%. And that's something that we're keeping a close watch on as we manage your investments, especially or particularly in non-retirement accounts. So something not an IRA or 401k or something. Capital gains from the investments from there are important for us to manage. And if capital gains rates are going to go up in a material way, that's something that we're going to need to look at. But really, if you think about it, Congress has to address this year. Because we're going to get into 2022 midterm elections. And if the Democrats lose seats, then this tax legislation may never actually move forward. I think one key takeaway here is that the president's infrastructure plan won't raise individual taxes right now. That's something that's going to come later. It's not a 2021 problem, probably a 2022 problem, and certainly before the election. At this point, corporate taxes really are going to help pay for this infrastructure spending. With the rate moving up to 28% from 21. The rate had been as high as 35% before President Trump and congressional Republicans cut taxes in 2017. And so I think the tax rate might go up a little bit. This increase in the corporate tax rate, as I mentioned at the very beginning of this, is priced in, we think. And so probably a small tax increase on corporate taxes, some tax on international revenues for U.S. companies, and that's going to be what kind of pays for this year. We also think that the president's going to levy a 15% minimum tax on income from the largest corporations, known as book income, as opposed to income reported to the IRS. This helps kind of close some of those loopholes. You've probably heard that Amazon, for example, doesn't pay taxes, and so it's going to make it harder for U.S. companies to merge with foreign businesses to avoid paying U.S. taxes. Apple also is technically in Ireland to pay a lower corporate tax rate. And they're trying, it's called inversion, and that loophole is trying to be closed by some of these minimum taxes on corporations and denying some of these deductions from this inversion thing. I think this corporate tax increase represents probably a 3% reduction in the S&P 500 earnings for 2022. So a slight blip, probably, but we'll see how that kind of flows through ultimately. Here's what we know right now about the individual tax changes for the tax proposal. First, and I'll say right now that the outlines of the plan are hazy and subject to change. We're trying to look ahead as much as possible, and this is what we're able to glean. First, the top individual income tax rate for taxable income above $400,000, as I mentioned earlier, would revert to a little bit more than 39.5%. Currently, it's at 37%. Second, eliminate the step up in basis at death and potentially create a taxable event when someone passes away. This one, I think, is going to be the most challenging for Congress to pass. It is hugely impactful. If grandma bought 5 shares of, I'll just keep using Apple because they're huge and everybody knows about them, 5 shares of Apple in 1981, and it's grown and grown and grown, and then she passes away this year, the purchase price of that steps up to whatever the price is at the day that she died. And so there's no capital gains for people to inherit. If that changes, that's going to really alter the way people do some of their estate planning. That's something we're watching very closely. Third, and this one's according to Goldman Sachs, the capital gains tax changes could create more of a focus on asset allocation and tax loss harvesting. And so I think what we can see is the actual shifts in income tax policy can change the supply and demand dynamics of municipal bonds and taxable bonds. Specifically, taxes go up, there's more of a demand for tax saving kinds of investments like municipal bonds. Fourth, the unified gift and estate tax exemption amounts would decrease from a little bit more than $11.5 million to where they are right now to $3.5 million for individuals, and then it's double that for married couples. So the portability will remain between spouses, but would be indexed for inflation, but it would be chopped by about 2/3. And so that is a big impact for wealthy families trying to transfer wealth to next generations. We lose a lot of those gift tax exemption amounts. The fifth item here is that deductions for IRAs and 401ks could be adjusted. There's a proposed flat 26% tax credit that would replace deductions on IRA contributions. Right now, IRA contributions are deductible, really kind of depending on your income and whether or not you're part of a employer-sponsored plan. And this would apply to other qualified plans like 401ks as well. And so it will be very interesting to see if deductions for contributions for IRAs get changed. This is another thing that we're keeping a close watch on. Sixth item here, the maximum amount of itemized deductions would be no more than 28% for those earning over $400,000. We don't know yet if this is for individuals or people who are married filing jointly. So as I mentioned, this is hazy, but this is still one of the things that we're seeing here in some of the proposals. Seventh item here, the earned income tax credit would be expanded to include people who are working at age 65 or older without children living at home. They're considered childless for tax purposes. I'm trying to expand that for people who are over 65 and still working. Eighth change that we're seeing has to do with the child independent tax care credit, increasing from $3,000 to $8,000 for one child and from $6,000 to $16,000 for two or more children. And then the maximum reimbursement would change as well. As it stands right now, these changes would only apply to the 2021 tax year, but I think there could very easily be an effort to extend these enhancements beyond just this year. The ninth item here is the first-time homebuyer tax credit would be restored with a maximum of $15,000. Under the current rules, there is no first-time homebuyer tax credit. And I know that's something that had been around for a while and is no longer there. And then finally, the 1035 exchanges where you can swap one annuity for another annuity without the recognition of gain. It would apply to real estate, like-kind real estate, where we're swapping one property for another. The Tax Cuts and Job Act limited 1031 exchanges only to real estate. Now there's a 1035 exchange, or there would be a renewed 1035 exchange where you can swap annuities as well without any tax issues. So I ran through those pretty quickly. There's a lot to cover, and I know we're getting kind of deep in the weeds. As I mentioned before, if you have questions, go ahead and throw them into the Q&A. I would be happy to answer them. I know we have a little bit more people here right now than we usually do for some of our seminars. So those are the issues that we're facing. There are we have on here 9 planning tips that you can discuss with your advisor here. And we can kind of keep an eye on things. I would say first, reduce the size of your annual capital gains if we can, trying to keep it below the top rates. Although I will say that if we have a window where we can kind of have some realized capital gains before capital gains rates go up, we might actually see quite a bit of volatility in markets as people are trying to scrub out all the capital gains from their investments. One of the things that we could also consider doing is increasing municipal bond holdings in non-retirement accounts. It doesn't really apply in IRAs and 401ks, but in non-retirement accounts, they're going to become more valuable with the increase in the tax equivalent yield. I would also consider decreasing dividend-paying investments or holding those kinds of investments in retirement accounts. That's one thing that you could do. And then consider bare bones investment only variable annuities to help defer income, try and reduce your taxable income from year to year. These kinds of annuities can work like a wrapper around your investments, where it's a little bit like an IRA, where everything's kind of contained in there. Now, I'll say at this point, IRAs or annuities rather aren't for everybody. They can be very useful for a particular set of people, but it's not for everybody. So again, I would encourage you to talk with your advisor to see if that makes sense for you. I would also consider, if you're able to, accelerate your income into this year. If you have income that's going to come to you in 2022 or further out, see if you can pull that forward and you can consider like installment sales and other kind of leveling income procedures so you can kind of pull forward that income into this year. Now would also be a good time to review your estate plans in light of the potential estate tax changes and the differences in lifetime gifting exemptions decreasing. And so I always think it's a good time every 5, 6, 7 years to kick the tires on your estate plan, make sure that it's still good, and you can either talk with your advisor or talk with your estate planning attorney about that. after about 5 or 6 years, two things change. Life changes and the laws change. And this is the law change side that we're talking about here. So it's good to go make sure that everything's situated correctly, so you can maximize things. You could also consider life insurance if you have illiquid assets in your estate, that you want to make sure that if there's going to be a big capital gain or something on, you can manage that. You could also work with your advisor on basis management to bring down your appreciated gains in the portfolio. This is what I was talking about a little bit earlier about kind of scrubbing out the capital gains now while our capital gains rates are lower, before they jump quite a bit higher. And I think you'll see a lot of people doing that. And then finally, charity. I don't think charity gets talked about enough. I just know in the clients that I talk to, a lot of people do charitable giving. And charitable giving can help decrease your taxes. And it doesn't just need to be writing a check to your favorite charity or your parish. You can do kind of more dedicated charitable giving planning using charitable giving vehicles like charitable lead trust, donor advised funds, donating appreciated stock to charity, things like that. There are some tools in the toolbox that can help with that. Kind of as we kind of start getting towards the end of this, there are some other kind of policy proposals I wanted to make everybody aware of. We're seeing Goldman's actually anticipating Congress to spend all new revenue and possibly more on infrastructure and spending programs. I'm going to pause here for a question. Business taxes increasing. Let's see. 1, business taxes increasing. 2, individual tax rates increasing. 3, printing more money. 4, high debt to GDP ratio. 5, possibility of pandemic due to vaccine hesitancy and variants. Isn't this a formula for economic and the markets to suffer? How can the above not cause a downturn? Well, I think there is a possibility there's always a possibility for a downturn here, right? I think the individual tax rates at the top tier going up by 2% probably isn't alone enough to cause a recession. Printing more money really is a stimulus that's gone on now. In fact, I would say that is stimulative, not that's not going to be something that hinders the economy. High debt to GDP ratio is an issue that we're going to be faced with tackling down the road. Again, I think if this is treated as an emergency situation, it's something that we need to get a handle on. And it's one of two ways: either growth increases or the debt decreases, right? And we're going to have to kind of grow our way out of this problem as much as we pull down the debt. I don't think that a second or continued pandemic due to vaccine hesitancy is one of the things that's in play here. If you go back to our last webinar that we did with Dr. Bill from Transamerica, it doesn't seem like the variants and the vaccine hesitancy is going to be enough to stop the progress that we've made on COVID. And so I think vaccine hesitancy is something that could slow our progress to getting to the other end of this thing, but I don't think it's enough to pull backwards. I would say right now, with low rates, stimulus, coming out of the recession, I would say this is a recipe for market growth, not for markets to suffer. The question then becomes, what happens in 2022, 2023, and down the road when we then need to pay up for all of the things that we've done to keep ourselves afloat during this vaccine or during this pandemic. Good question, though. So back to some of the other policy proposals, we're seeing a proposal for broadening healthcare eligibility under the Affordable Care Act, lower Medicare eligibility to age 60. I can tell you one of the things that I see with people waiting to retire, it's often waiting until age 65, and it has everything to do with health insurance and nothing to do with how much anybody saved. We're also seeing, I think, as far as regulation, I think this is kind of a consensus. It's unlikely we're going to see substantially different legislative outcomes when it comes to regulation. I think it's going to be influenced through appointments. We just saw one of the president's appointees having to do with monopolies and antitrust just get appointed. So that's an example of a different way, not legislatively, but we're going to see regulation through the administration. And then I think the last one here, the attempt to abolish the step-up basis in death is something that we're still watching very closely. I know I mentioned this already once. It's an important element here as far as estate planning is concerned. Okay, so I don't see any other questions. We'll keep going here just a little bit. A few takeaways. We like numbers, and so we're going 1 to 9 again. A surge in vaccines is helping to reopen the economy, contributing to the reflation trade, as I mentioned. Since the start of 2021, small caps have had better returns all around compared to large caps. Small caps are the smaller companies that have more room to grow. And when things are going well, you tend to see them benefit the most. And when things are going poorly, they're hurt the most. And we're seeing them benefit more than others. Although there's been a recent downturn for small caps here lately. Dow performed the NASDAQ by the biggest margin since 2006. We also saw smart money not do so well. As I mentioned, the GameStop and meme stock stuff with some of the fad investing with NFTs and Bitcoin and cryptocurrency and so on. Debt levels are historically high, but interest rates are historically low. So the cost of servicing the national debt is at a more normal level now, but that may not continue as interest rates go up down the road. The president's stimulus and vaccine program and the infrastructure bill, we think is going to jumpstart the economy and create new opportunities for work. And then analysts expect inflation to remain broadly in check, at least over the next couple of years, although further down the road, it may become an issue. And again, the Fed's going to hold steady with rates probably until 2024. And then more broadly, strategists think that S&P 500 will reach 4,300 by the end of 2021. We always say this, don't try and time the market. It's time in the market, not timing the market. You're never going to be able to perfectly predict the ups and downs and the swings of the market. So your best bet is to stick with it. We've seen huge returns now, 3 out of the last 4 years, and this year could make it 5 out of the last 4. And so no one would have ever dreamed that this time a year ago. And so I would say stick with it, most importantly. And then taxes are going to be increasing. So work with your advisor here to prepare for the inevitable, right? There are some strategies that can be done both in the management of your portfolio, working with your estate planning attorney and working with your accountant to make sure that you're well situated to handle what's likely going to come, maybe not in 2021, but before the midterm election 2022. So we covered a lot. We've been going for 50 minutes, a few questions sprinkled in there, but a very dense material. And that's why I hope these 9 key takeaways have helped. I want to thank you for joining us for this. As I mentioned before, we're going to have the replay on our YouTube page, and you can take a look at that. If you have more specific questions as some of these topics relate to you and your own situation, if you're not working with an advisor, I would encourage you to get in touch with us so you can work with one of our advisors here. If you are working with one of our advisors, I would encourage you to give them a call or email them if you have any questions. You probably hear from all of us from time to time. A lot of times when I call folks, it's, oh, hey, I'm glad you called. I've been sitting on this question I've been meaning to ask you. So don't hesitate. Reach out to your advisor and talk about some of these financial planning issues that we have. We're going to try and do this again at the end of next quarter. We're going to have our midterm. It's hard to believe it's April 21st already. We'll have our mid-year review as we get into July. A lot can go, as we saw in the first quarter, a lot can go on in 3 months. And so we'll try and cover some of these things again. And so I look forward to talking with you at that point again in a few months. So I look forward to talking with you more, work with your advisor to discuss your financial plan. I'll open it up one last time to questions. I don't see anything in the Q&A. So I guess we will leave it there. My name is Brian Ullman. I'm an advisor here at Ford Financial Group. Thanks for watching, and I look forward to talking to you next time.